In today's session of Visual Jforex, we will be continuing our work with the indicator named CDMI, which stands for Chande's Momentum Dynamic Index. So now let us head to the Visual Jforex board, which has been developed by the Dukascopy Bank SA. In a prior session, I had added these blocks in which the instrument subscription for the Euro USD has been done and the position amount was defined at 0. Then these four CDMI blocks have been taken. First two are of hourly time frame, whereas these two are of 5 minutes time frame, and these four will be used in conjunction with each other to set the conditions which need to be in place prior to the execution of the trades. To look at the price momentum in terms of the price action, I am also going to rely on these get historical candles, in which the candle amount has been defined at 0, and to retrieve the individual variables, this loop viewer will be used, and get historical candles of 5 minutes, and these two are of 10 seconds to pinpoint the entry point. Now we have to define the conditions for the execution of the buy trade, and as I had explained to you in the prior session, the logic is fairly simple, and now in today's session I will explain to you the logic behind the buy trade. So we need the CDMI value to be shifting gears from bearish to bullish when we are looking for the buy trade. In terms of sell trade requirement, it will be reverse. It will be inverted condition where we will need the CDMI to drop below 50 from above 50 for buy trade. This is from below 50 to above 50. So as and when that requirement gets fulfilled, the focus then will shift to the other contributing factors, other conditions, and suppose now here, provided the other conditions are in place, we will need the Euro USD CDMI value to first, it should be in the oversold territory, and from there on it should be picking up the momentum. So we will need fair amount of correction in the Euro USD in this case, and then only whenever we see the reversal happening, then we will be looking for the execution of the buy trade. So if the hourly condition was in place somewhere here, the buy order might have been placed, as we have the CDMI value below 30, which defines the oversold territory, and now it has shown that it is now rising above 30 from below 30. So that is our condition. We want this kind of scenario playing out, and we will be looking to go for the entry trade, and as you can see, it does hold the ground, and then the spike is seen in the Euro USD, and we have substantial gains ahead. So this kind of trading opportunities will be identified using these indicator, and as I said, we have different factors which also need to be fulfilled, and one of the factors is going to be that there should be good enough momentum. So for that, what we will do, we will take into consideration the high and the lowest value of last 4 hours, so that makes our job simple. And I think for the instrument like Euro USD, 20 pips is good enough. For different instrument, you will have to observe the chart and see what is its normal range, what its range is like when it is trading sideways in a very narrow range. So you can get the idea where the momentum is good enough to go for the fresh trade, and it is likely to bring in profit. So during such instances, only when there is enough of momentum we want to get involved, and that's why I said that we are also going to use these 4 historical candle cluster, and to look at the immediate price action before the execution of the trade, we will also want that last 5-minute candle should have closed higher than its opening price. So along with these CDMI value, one other confirmation factor will be this price difference between the opening value and the closing value for last 5 minute candle. So that's how we are going to go about this trade setup. I hope you have got the point. And now is the time to bring in the additional blocks which will help us define the conditions. And first will be the calculation expression block where I will define 20 pips, and then we will also find out the actual difference and then compare the both of these values to see whether there is enough of momentum or not. And for defining of the 20 pips, first thing we have to do is take pip size. So we have now got the pip size for the default instrument in this case, which is Euro USD, and then I will create a new variable pip difference value, which is going to be 20, and then the job is fairly simple. All you have to do is A1 multiply it by A2, and here you have your value of 20 pips minimum pip difference. Okay, and then I will take one more calculation expression block, and here we will compare the actual high and the low of FHL. So for that I will have to look at the candle high and its low and find out its difference, which can be done like this: A1 minus A2, and this is going to be actual pip difference. So we will compare these two values. All right, and I think we should also make sure there is enough of momentum in last 5 minutes. It shouldn't be the case that the many times what happens when there is not much momentum. Even in that scenario, if the underlying instrument is sideways, even in that kind of situation, we can have false signals from the indicator, and to avoid that, I think we should add one more condition, that there should be enough of momentum, enough of difference between the closing and the opening value for last 5 minute candle. And for that we will set the condition of 4 pips for 5 minutes is I think good enough choice. So that will help us avoid false signal when there is not much of a momentum. Okay, so again we have to define the 4 pips value, which we will then compare with the actual price difference. This will be FPV and its start value will be 4. This is going to be A1 into A2. Okay, I have named it FMP, and then comes one more calculation expression which is going to help us calculate the actual price difference of the candle 22. So we will take candle 20 seconds high and deduct its low. Similar kind of calculations in both of these cases. A1 minus A2. And the result of the calculation, I will have to name it, which will be AFV. Okay, so far so good. We have put in place this calculation expression block to carry out these calculations to set the conditions for price volatility. Now I will bring in the multiple action block, and after that we will start defining the conditions for the actual execution of the buy trade. And here it is. Oops, I overlooked it. This is if block. Sorry. I will leave some space there. Okay. And if block will be joined. Now, the first condition is that momentum should be shifting from the bearish zone to the bullish one. And for that, we have to compare this hourly output for CDMI. So this out 13, which is the last hour CDMI output value. It should be above 50. So let us go to the chart, and here you can see that 50 is the defining point. Below 50 is considered bearishness, and above 50 it is considered bullish. So we rely on that system of traditional use of the CDMI. Okay, and this should be first input greater than second input. In case of out 17, which is the hourly CDMI output value with the loopback period of 2, and this should have been below 50. So in this case, first input less than second input. Okay, then we shift our focus to the 5-minute CDMI values, and in this case 30 is going to be the decisive marker. When we have the values below 30, that means the underlying instrument is in oversold territory, and whenever the bounce back is going to happen, the value will again shoot back above 30. So these two CDMI blocks with the loopback period of 1 and 2 respectively, these blocks will help us identify such moments. So in this case, out 19, which has the loopback period of 2, its value should have been below 30, and to that I will add a block first input greater than second input. This should be first input less than second input. Okay. And out 18. In this case, the condition that first input greater than second input. Second input is going to be 30. Okay, so we have these conditions in place, and then we shift our attention to do the comparison between the actual price difference and the minimum difference requirement. So in this case, we will have to carry out this comparison of the AFP with the FMP, and it should be first input greater than second input. For that, I will join it like this, and then next, in this case also, APD should be, oh, I got this block wrong, I kind of overlooked it, pardon me. And again, the APD should be greater than MPD. And one more condition is also going to rely on the 5 minutes candles closing and opening values. So for that we want candle 22's close to be above its opening value. Yes, needs to be greater than the open price. Okay, and then all we have to do is define the exact execution points for which we, as is the customary practice, take into consideration the last two 10-second blocks and the prior 5-minute candle in this case. So we will have to compare candle 23 and candle 24 closing prices. So we got these values and we will compare it to candle 22nd candle close. So here first input should be greater than and in this case first input should be less than second input. Okay, so we have got this points, and I think with that most of the conditions have been defined, so we won't really need this additional if block. Instead of that, we can now go for the execution block. In this case, we will be going for the buy trade at the market. So here first input less than second input, and then we will have to define these input parameters depending on which the other orders apart from the buy order we have to also place the stop loss and the take profit order and also the slippage, and not to forget the position amount. So all these factors, all these parameters need to be well defined, and for that we will be going back to the chart and see what are the appropriate values which are likely to bring in good amount of profit in case we happen to be right, while minimizing the losses in case of we or our anticipation proving wrong. So all we are using 9 conditions which need to be fulfilled for the execution of the trade, and after that these parameters need to be defined. Here for example I am keeping it simple at 0.1 million. Default slippage, I think 2 pips should be good enough. Now comes the tricky question of stop loss and take profit. We are working with the trend, and for that we are going to definitely rely on these buy and buy trade only in case of bullish momentum, and I think that gives us some headroom for keeping the target price fairly wide as we are trading with the trend, and in some of the cases we will see significant move on the higher side in continuation of their trajectory, and we want to catch those instances. So I think if we consider the ATR for Euro USD, it is generally around 60 to 70 pips for the day, and looking at this price formation also, I feel if we go for the combination of say like 30 pips target price and 15 pips stop loss, that should be good enough. The 15 pips stop loss will make sure that the risk reward ratio is in our favor, and if the stop loss happens to hit, then we won't really be see execution of a new trade till considerable time has passed, and only whenever the reversal will happen, only then the order for the new buy trade will be placed. So the chances of false signals and whipsaw trades can be avoided using this combination. Of course you can go for different combination. It's all about individual choice and trading style, and there is nothing called the perfect combination. So in this case I will change it to 15 pips and 30 pips. Okay, output value will be the position. Okay, so with this the buy side setup is complete. In next session we will define the conditions for the execution of the sell trade, which are going to be the inverted mirror image of the buy trades which we have done in today's session. So I thank you all for joining in. Have a fabulous time ahead. See you next time. Till then, goodbye.